Let me swing back to some of the more, I guess, macro sector questions here, especially around mid-sized banks, because I can remember when Silicon Valley imploded and we had a few other bank failures, everybody was suddenly panicking that
Yeah,
mid-sized banks in particular were going to go under.
right.
And here we are 6 months later. That really hasn't happened. And even just looking at some calc bench data, I saw that deposits at mid-sized banks, they're still there. So what happened to this supposed instability we were going to see? Or if we were going to see troubled banks, where would you look for that? What sort of disclosures, regardless of where the bank is, how big it is, what are you looking for to identify this is a trouble thing here?
Yeah. Um, that weekend, I tried to ring fence what was happening for our investors and explain this. There's a cohort that's happening here. These banks they're in trouble, and it's a combination of high uninsured deposit
Mm-hmm.
concentration, and then extra. That that was an outlier in that department, and an outlier or in that statistic, and an outlier in long duration assets. So a case in point would be Silicon Valley stretched and overwent long duration securities and they're at because they had this tremendous, in their defense, they had a tremendous inflow of deposits because the venture capital was I mean, they almost doubled the company in 2 years. So they put it in securities because they actually had a tremendous lending credit quality culture, so they put it in riskless securities, but unfortunately they went a little bit too long. So you had this long duration asset that was now underwater, and then you had a more risky deposit franchise, which I think they thought was going to be stickier than it turned out to be. So, not pointing fingers or anything, but that was the two risk factors that what analysts keyed in on immediately on that Friday. And then we had Signature fail, and then First Republic came under risk, under pressure, and they also had not so much securities, but they went long mortgage with I think their coupon was like 2%, 2.5%, and then the current coupon was 6. So if you mark that to market on a sizable loan, that's a huge negative mark to equity,
Mm-hmm.
massive mark. So, and then if deposits are running out the door because they're uninsured, so the retail depositor and the corporate CFOs woke up and said, I can't be a risk here. I need to move to safer ground. So what you did see in the Federal Reserve has H8 data, which we look at. We did see that they stratify it as top 25 banks and then all others. So we did see deposit inflow into the top 25, the too big to fail, if you will, away from the smaller banks. But then that reversed, I think, after the Fed came out with their overnight funding facility and others. I think people realized that it was like not all banks are going to fail. This is this is almost like niche banks that had this, like I talked about before, like this concentrated niche deposit franchise that was oversized, if you will, or relative to the FDIC insurance. So that people kind of got their calm down and realized, okay, this is more of a 10 bank phenomenon, not
Yeah.
industry wide, which was a good thing. I think Warren Buffett came out and said something like, no consumer will lose his or her deposit in this country, just because he knew the Fed did guarantee, or the FDIC, excuse me, did guarantee the deposits of Silicon Valley and Signature, just to try and say, okay, let's not have, we didn't want a widespread industry run.